You guys keep asking and asking, should I get into WETG stock? Should I sell out of WETG stock? You keep asking and asking, and you know what, guys? I got an answer. Today, we're going to find out the secret behind averaging down. Should you do it? Should you not? We're going to go into all that and more. You guys don't want to miss this one. All right, you guys, welcome to the channel. This is the channel for traders who are sick and tired of losing to the banks that do everything in their power to take their money. I am here to give you an edge so that you can fight back against the banks, to beat the banks, so that you can live a profitable and free life. Today, we're going to go over WETG stock and averaging down. So let's take a look right now. What did we say about WETG stock before it really started to drop? What's most likely to happen is it's going to range tomorrow, and then either on Tuesday or Wednesday, it's going to break out to the upside. Okay, 14, 15. It could even go back to $20, although I'm not expecting a move that explosive. All right, here's our stock right here, WETG, aka We Trade Group. I actually have a historical chart pulled up right now. So this is a historical chart, and it shows actually when I called out this stock. Okay, so this stock came down here, right? It came down here when I called it out, and I had a profit target of here at around $12.20. Okay, 12.20. This is back when I was promoting the stock. Okay, I was promoting the stock. However, did I promote the stock and say buy it, hold it, and hope for the best? If you hold a position for the range, you definitely want to stop below $10. If it goes below $10, then that's a break to the downside. That's where we can get into some serious trouble. So if you are going to take a position here, make sure to put a stop just below $10. Always use a stop. Always use a stop. Always use a stop. That's the last time I'm going to say it, because from the rest of this video, I'm expecting you guys to use a stop when you trade in the stock market. Absolutely not. Absolutely not. In fact, what I actually said was make sure you buy on confirmation and use a stop loss. However, there are some traders who are still holding this stock. So we have to help those traders. In my opinion, we still have to help them. We still have to help anyone that has bought this stock. If you are holding the stock, my deepest condolences. Look at this. This stock came above our buy point just a little bit, and then it actually skyrocketed in the pre-market, came up to about $11.96. It went from about $9 to $11. So it's already up 15%. And then it shot up all the way to $12.49. So it actually did hit our profit target, but it was a day late. Okay. So when I was promoting this stock, it was actually on this day. Okay. So I wasn't able to call out the exact day when the stock really took off, but it did take off the next day. That is cool. That's great that you guys now know that. You guys know where I said you should buy the stock. But then what happened? Well, I did recommend putting a stop loss below $10. Okay, below $10. So when you guys trade a stock, especially when you day trade a stock, especially when it's a parabolic, super dangerous stock like WETG, We Trade Group, use a stop loss. And I'm so sorry if I sound a little bit like a broken record here, but you need to use a stop loss. It's so important to use a stop loss, because these stocks, yes, they can definitely perform well, but they can also perform very poorly. In fact, they can have some of the worst price action out of any stock in the stock market. So when you guys trade this, again, I said stop loss below $10. $10 is right here. So theoretically, if you got into the stock when I asked you to around right here, you should have sold the sell target and you should have been out of the stock and you should have been done for the day. But let's say you held on to it. Let's say the price continued to drift on down. Well, where do you sell out? Where do you say enough is enough? I'm getting out. Well, I said below $10. So about right here. is where you would have called it quits. Okay. If you were following the trade plan. Now, even if you don't follow my trade plan, you can still have your own trade plan. So maybe you want to get out at $9, maybe $8. But in any case, there has to be a certain point where you want to get out of the stock, because otherwise you're going to end up like the traders who are holding this stock right now. And I'm serious. It's my deepest condolences to them. I don't want anyone to have to deal with this, but this is what happened to the stock. Okay. So the stock went up again to that, it went 18, went up to back to up to 11, and it has drifted all the way down from that $10 level, and it is now at $1.53. Okay. And that brings us to the main topic of this video: averaging down. Averaging down. Should you average down? Should you, a smart, reputable, professional trader, average down your stock price? If you buy it at a certain price and the stock price goes down, should you buy more shares? Should you purchase more shares so that the overall cost of your trade goes down? When you purchase more shares and the overall cost of your position goes down, what that means is that the stock price doesn't have to go up that much in order to bring you to the break-even point or even to profit. So if we buy 10 shares at $10, okay, we buy 10 shares at $10, and then the price comes down to $9, okay? If we buy 10 shares at $9, then our average cost is $9.50. Now, if the price comes back up to $10, our average cost is $9.50. So we will technically be winning that trade if it goes back up to the $10 level. That's cool. That's awesome. That's great. That's amazing. And it's absolutely going to get many, many traders bankrupt. Going to blow up their accounts. Why? Why is averaging down so dangerous? Well, you guys know that when I trade, I always trade on confirmation. And I always ask you guys to trade on confirmation as well. Confirmation basically means that we have to see the stock going up if we're going long before we take a position. We have to see the ensuing price action that we're looking for. When I release trade protocols to my students, I always have a set level or a set range where if they get into the stock, they have to pay this much or greater for it if they're taking a long position. They cannot buy it before it gets to that price. Why do I do that? Why don't I just tell them, buy the stock right now? Because if we don't enter on confirmation, if we don't see the trade going in our favor, then we don't know where the stock's going to go, really. We don't know if the stock's going to go up or down. We may have an idea, we may have a plan, but until we get something in the price action that actually proves our plan to be true, it's like a scientist, right? The scientist comes up with a hypothesis. Until he finds out that there's some kind of evidence that his hypothesis is correct, then he's not going to take the trade. He's not going to get published in a journal or anything like that. And for us, we're not going to take the trade. If we don't see confirming price action, we're not going to take the trade. What happens if we do take the trade? Well, then we don't know if the stock will go up or down. What do we do then? Well, if it comes down to a stop loss level, we're going to get out. We're going to take a small loss and we're going to get out. That's the way we trade. But what about the other way of trading? What about averaging down? Well, that's doing the exact opposite of what we do. Just for reference, that's exact opposite of the way that me and my students trade. So essentially when you're averaging down, and I'm not saying you, I'm saying when a trader averages down, they are buying on disconfirmation. The trade is literally going against them. It's telling them you're wrong. And then the trader buys more. So instead of telling the trader, you're right, it's going in your direction, now you can sell your position for a profit, or you can take a position. The price action is saying, you're wrong, the stock is going down. You got to get out of this thing. You're losing money right now. But some traders will see that downward price action. And don't get me wrong, there's some strategies where you can average down and it can work out for you. But there always has to be a level where you get out, where you say uncle. Now, what about the case that the market action, the price action, it says you're wrong? And sometimes we are wrong. Okay, sometimes the price doesn't go in our favor, even when we have confirmation. But when we average down, we are literally taking disconfirmation and buying more. We are buying the opposite direction of our trade. And as a result, the price can go lower and lower and lower. And there's really no end to how low that price can go. And this goes for WETG. This goes for GCT. And GCT did turn out a little better. Okay, so GCT, it at least got a jump, today. It got a small jump here. But really, the people that bought up here at $67, they're still 75% underwater. So anyone that averaged down and bought more shares, if they bought shares here, if they bought shares here, 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 then even if they're still holding the trade, they're still underwater. The averaging down didn't save them. And averaging down won't save traders most of the time. Okay. And this is really, really important to understand because, as you guys know, I hate when you guys lose money. Now, WETG didn't have such a happy ending. This stock went from $20, right? Or actually, it was at $50 at one point. This stock went from $50. It's now trading at $1.55. $1.55. Yeah, this stock is trading at $1.55. 1/50th of what it was trading at before. What do we do if we average down? Well, when we average down, we now know averaging down is literally buying on disconfirmation. It's buying more shares when the trade says that you're wrong. And we know now that if we buy more shares when we're wrong, we're more likely to lose the trade. If we buy shares when we're right, when the stock is going in our direction, then we're more likely to win the trade, especially when we buy past the pivot point at confirmation. But when we buy as the stock is going down, then we're buying on disconfirmation. We're lowering the overall cost of the shares, sure, but we're also digging a deeper hole for ourselves, and there's no sign, there's no promise, there is no guarantee. The market does not make guarantees. There is no guarantee that the price will ever come back in our favor. And that's why you guys should never average down. Okay? Never average down unless it's part of some very particular strategy or swing trading. Then you have my permission never to average down, because if you average down, you are buying on disconfirmation, and you're going to end up like the traders who are holding WETG, who have my deepest condolences. Thank you guys for coming to the channel. Thank you for learning about day trading and how to day trade effectively. Go ahead and join our free Discord. Link is in the description. If you are interested in day trading with me live, receiving coaching so that you can become a profitable trader. I will see you guys in the next video. Have a nice day.